What if the biggest opportunity in the U.S. stock market this month is hidden inside volatility? In the second half of March 2026, investors are facing a critical moment. Markets are reacting to economic expectations, interest rate signals, and global uncertainty. Some investors see danger, others see opportunity. But here is the real question. Will the U.S. stock market rise, fall, or simply move sideways in the coming weeks? In TI's video, I'll break down what could happen in the American stock market, the risks of volatility, why having an emergency reserve is essential, and the long-term strategy smart investors are using right now. The most realistic expectation for the second half of March 2026 is continued volatility with short-term fluctuations. Markets rarely move in a straight line. When investors react to economic data, interest rate expectations, and geopolitical factors, the result is often rapid ups and downs. However, volatility does not necessarily mean a market crash. In many cases, it represents temporary adjustments while investors reassess risk and opportunity. This means the U.S. stock market may experience short-term corrections and rebounds, but long-term investors typically focus less on daily movements and more on structural economic growth. That's why preparation is more important than prediction. Let's break this down into 4 key elements every investor should understand. 1. Market risk of RE. Stock market carries risk. Economic data releases, interest rate expectations, inflation signals, and global events can influence investor sentiment almost instantly. In periods like this, markets may react strongly even to small pieces of news. This is why experienced investors never assume the market will only go up. 2. Volatility is normal. Volatility is not necessarily a negative signal. In fact, volatility is part of how markets price information. When uncertainty increases, price movements become faster and sometimes more intense. For traders, volatility can create short-term opportunities. For long-term investors, it often creates discounted buying opportunities. The key is emotional discipline. 3. The importance of an emergency fund before investing aggressively in stocks. One rule is fundamental. Always maintain an emergency reserve. An emergency fund protects investors from being forced to sell assets during a market downturn. Without financial stability outside the market, investors often make emotional decisions, selling at the worst possible moment. A strong financial base allows you to stay calm even when markets fluctuate. 4. Long-term strategy. Historically, the U.S. stock market has rewarded investors who think in years, not days. Short-term predictions are extremely difficult, but long-term strategies based on diversification, disciplined investing, and patience tend to outperform reactive trading. Instead of trying to time every market movement, successful investors focus on consistency, risk management, long-term growth. What should investors expect in the second half of March 2026? Most likely, volatility, temporary fluctuations, and market reactions to economic signals. But the real lesson is this. Short-term uncertainty is normal. Risk management is essential, and long-term strategy remains the most reliable path in the stock market. If you maintain an emergency reserve, understand market volatility, and focus on long-term growth, you position yourself far better than investors who react emotionally to every market movement. Because in the end, successful investing is not about predicting every move. It's about staying prepared for them.